Hi, how are you? First of all, please, it's very important that you help me to continue creating content. Subscribe to the channel. The swing trade is a type of operation that lasts more than a day and is mainly suitable for people who want to trade in the short and medium term. We need to make it clear that there are different types of investments, with a huge range of financial products. Among all these products and investment profiles, one of the classifications concerns the time when the operation starts and when it ends. The main terms used to differentiate the duration of operations are day trade, swing trade, and position buy and hold. A swing trade is a type of trade that lasts more than one day. To be considered a swing trade, the operation must start and end on different days, and may last 2, 3, or even more days. It is mainly indicated for people who want to carry out short and medium-term operations. Also, it is not common for the deal to last longer than 2 or 3 weeks. Who swing trades? This type of operation is recommended for those who want to make short-term trades and investors who already have some experience in the investment world. That's because, even if they last longer than a day, overnight market movements can scare off those investors less prepared for volatility. Therefore, it is always very important to respond to the investor profile and for the investor to update it, so that the products offered are in line with expectations. The swing trade is also recommended for those who are knowledgeable about the market, but do not have enough time to dedicate themselves exclusively. As they are longer operations than day trades, those that are opened and closed on the same day, investment horizons are also proportionally longer. As such, they don't need tweaking all the time. Goal: the swing trader seeks to obtain gains from the macroeconomic analysis of the market in general and the sector in which that company is inserted. However, the main focus should be on assets discounted in the short term and/or assets that have recently suffered from a specific event that affects the market in general, but that does not change the company's operating dynamics. In other words, events that increase investors' risk aversion, distorting the pricing of assets, but that do not directly harm the business of the company in question. Forms of analysis. The best school of analysis for swing trades is technical analysis, which is the study of price behavior over time. It is a branch of studies aimed at short-term horizons. Suggested chart times should be 60 minutes, daily and weekly, as they reflect longer period trends. Advantages and risks. One of the advantages of swing trading is the fact that the strategy does not force the investor to get right what the movement of the asset will be on the day in question. The rationale behind swing trading is to identify short and medium-term trends. Other than that, as mentioned above, because the operation takes longer, it does not demand the investor's exclusive attention and dedication. As for the risks, it is very important that the operator follow his trading plan and risk management with discipline, so that he does not prolong an operation too much and end up losing gains that had already been achieved, or even increase the size of the loss with the hope that the trade returns to work and ends up losing more money than it should per trade. To conclude, it is essential that the investor uses tools such as stop loss and stop gain, which are orders programmed by the investor to automatically close a trade when the stock reaches a certain predetermined value. Thank you very much. Subscribe to the channel. And see you next time.